Should you sell options during earnings? Now, on the one hand, volatility is higher during earnings and therefore you get more premium. But on the other hand, your position could be in deep trouble if you have a massive move against you going into earnings. So in this video, I'm going to show you how to sell options during earnings using a very specific example. In fact, it's a trade that I did yesterday. So let's get started. Well, first, let's look at selling options during earnings from a high level. So as I said, there are two main things to consider when selling options during earnings. Number one, you have higher volatility, which means more premium. But on the other hand, number two, the potential for a large move against your position. So let's start with number two. Because there's a potential for a large move against you, I don't like to sell puts going into earnings, but I like to sell calls. Here's why. When you're selling puts, you have to buy the stock at the strike price that you sold. Let's take a look at a very specific example right now. For example, Novavax. No, I did not trade this. I'm using it as an example. I'm showing you my trade in just a moment. So Novavax, as you can see, they reported earnings yesterday and the markets didn't like it at all. They were plummeting down 30%. Now, if you would have sold the 52 put, and if Novavax keeps falling to, let's say, down here, 35, by expiration, you would have to buy Novavax shares at $52. So you're instantly $17 in the hole. And based on the strike price of $52, that would be 33%. So that's not good at all, right? So this is why I never sell puts with expiration dates that are before earnings dates. In fact, our scanner in this tool, PowerX Optimizer, automatically filters out those so that I don't even see them. It makes my life easier. However, as I said, I do like selling calls into earnings. And let me show you an example of a trade that I did today. And so we're jumping over here to another stock. And see, a while back, let me just zoom out a little bit. There we go. A while back, I sold put option on Tapestry, TPR. And I got assigned at 37. So now I own 2,700 shares of TPR at a cost basis of 37. Now, since I own the shares, I can now sell calls against these shares. And when selling calls, I want to make sure that I receive enough premium to make 30% annualized. Now, you also see here that Tapestry is reporting earnings on Thursday, August 19th. So that's after this week's expiration because I'm recording this video on August 10th and this week's expiration would be August 12th. But this here is a day before next week's expiration. So let's take a look at the options. This way you can see what's happening when you sell options into earnings. So I'm jumping over here to my calculator and this is now, I don't want to sell puts, I want to sell calls. And I want to sell calls of TPR. The stock purchase price was $37. We are looking at next week's expiration and 2,700 shares and are looking to sell it at a strike price of 37. So let's see what premium we can get. And I'm heading over here to my trading platform. And we see that right now the bid ask is 45 cents over 55 cents. So this means that we could possibly get the mid price, which is right here at 50 cents. So that's pretty good because it would give me $1,350. So since they expire, we have days to expiration here, 9 days. So therefore I'm making $135 per day. 49% annualized. So the question is, does it make sense since they report earnings the day before expiration? Well, this is why I like to look at the earnings analysis. This is where I see, yes, they're doing it on August 18th. And I also see that historically, over the last 20 quarters, 17 times they beat earnings, 2 times they missed it, and once it was exactly what was expected. We also see the price move reaction on the 7th day, and I'm moving a little bit in. So this means that after 7 days, how much did the stock move? And you see it was up 36% of the time, 37%, and 63% down. So does this help here at all? Well, here's the deal. As you can see, when there was a surprise to the upside, it moved higher by 11.8%. And on average, when it moved lower, by 5.8%. And if I'm looking here at the last few quarters, see during last earnings up 18%, down 2%, up 8%, then down 0.5%, down 2%. So you see the surprise is always to the upside. In fact, the last time that they had a down move of 18% was during April 2020. But as you can imagine, in April 2020, this is when we had the pandemic. So all stocks were going down. This had nothing to do with earnings. So as you can see, the surprise is usually on the upside. So what does this mean for selling my calls? Well, this is where now I could consider and seeing if I want to take advantage of possibly a higher move. So I'm doing the same calculation, but instead of selling the 37 call, so let's just go for next week, 2,700. I want to go for the 38 call. Now, why would I do this? And let's see how much premium we can get. So I want to head over to my trading platform. And it seems that the last traded price was 33 cents. So maybe we can get 35 cents, right? If we wait a little bit and put a fishing order in there. And what does that mean to us? So if we would get 35%, I get $945 in premium. And now you might say, why would you do this? I mean, you make $1,350 right here. So why would you go for less? Well, if the stock moves past 38, I'm making an additional $2,700 on the stock. So therefore, as you can see, this is the bird in the hand where I make $1,350. This is the two in the bush where I could make up to $3,645 if we have a surprise to the upside. So therefore, I believe looking at the earnings analysis is super important so that you know what to expect going into earnings and then make a decision of whether it does make sense to sell at the assigned price and not make any money on the stock, collect maximum premium, or whether it makes sense to go out one strike price. And this is exactly what I chose to do. So therefore, right now, I am trying to sell 27 calls because there's the amount of contracts here at 35 cents, collecting $945. And if TPR by expiration date, August 19th, has rallied above 38, I'm also making an additional $2,700 on the stock. So as you can see, it's important that you know what is heading into earnings. And another important topic is buying back these call options that I'm selling to maximize your profits. So the question is, why should you even consider this? And how does it help you to make more money? Now, I did a video on this, so check it out right here. It's popping up here or here. Take a look at this video and I will see you over there.